Now, joining us right now, Jay Brinkmann, chief economist at the association, also Mike Fetter, president of Radar Logic, which tracks home prices across the country. So, Jay, let me toss it out to you first. I mean, we still see a lot of folks going delinquent on their home. We're still seeing a lot of foreclosures.
We are, and it's tied to the jobs numbers that you need a paycheck to pay your mortgage. Certainly, we've seen some turnaround in the economy, but GDP percentage increases don't pay the bills. So until we see some turnaround in the jobs numbers, we're still going to see increases in prime fixed-rate mortgages going bad, and still ongoing problems in states like California and Florida, very much driving the national numbers.
Mike, same thing. I mean, until we get that labor market turned around, it's going to be tough for housing to fully turn the corner here?
Well, certainly, because Jay's absolutely right. If people don't earn a monthly paycheck, they just can't pay their mortgage. But I think, the housing market, certainly in the figures that we look at, has certainly found some legs, has shown greater stability through the early part of this fall than it has in any of the past 9 years. The big question now is whether these delinquencies are going to turn into defaults and foreclosures, and what that's going to do to overall supply and demand, and therefore prices.
Let me ask you, your RPX index fell 3.1% month over month. That's more than typical for this time of year, and 26% of all sales were foreclosures. Are foreclosures driving this market here?
Well, I think certainly, Matt, the foreclosure activity, or distressed activity as we call it, is driving that most of that decline in price that we saw month over month. September is typically a weaker price month than August, given normal seasonality. Interestingly, activity was higher this September than in August, which was the first time in 9 years that we've seen that.